Well, I think I've unmuted myself by now. Can you hear me okay now?
All good.
Well, maybe we'll get underway here now that we're officially being recorded. My name is Mike Galbraith. I'm a primary care sports medicine physician here in the bustling metropolis of Tyler, Texas. And I'm really excited to be with you today to talk about one of our sports economic series webinar, the General Financial Planning for the Young Physician, to have our special guest here, Anthony Corio. Now, I feel horrible now because he is currently living just outside Philadelphia, so we're pulling him away from the baseball game. So, I mean, we want to abuse you, we want to learn from you, but hopefully we won't keep you hostage for like hours on end.
That's okay. It's okay.
Now, I have to ask, do we have the game just like running on a screen right next to the computer?
We don't, I thought
Good.
about it. I did think about that, but I can manage for now.
I don't want to give you ideas. So, well, we really appreciate you taking the time to be with us and to learn from your wisdom. I believe this is either the 5th or the 6th sports economics webinar, and I think this is a little bit different than the typical webinar AMSSM puts on. And this is just a great resource that you can find on AMSSM's YouTube channel. So it will be saved for those people that are accessing this either now or even later. You can go back and look at our website and review that too. So what I'd like to do is I'm actually share a screen here that will introduce a bunch of the different questions, have a chance to actually introduce Tony a little bit. So forgive me, let's see if I can share this screen okay. Okay, here. All right, is that coming through okay there?
Yeah, Mike, we are all good.
Perfect. See, that's us in all our majesty with good lighting and haircuts. We look fantastic. First of all, we'd like to thank the AMSSM. It's just a wonderful organization of education run by many primary care sports medicine physicians. So thank you to all these different committee members that make this happen, really. And also thank you to you viewers for chiming in now, for taking time out of your Wednesday evening, and taking time away from the Phillies game. So we really appreciate you joining us. Now, what we encourage you to do is there is the chat function. So those that have any questions along the way, we'd like you just to input in that chat function. And at the very end, we'll make sure that we try to address all the questions that you might have. We'll do the best that we can. And then also we'd encourage you too on our YouTube channel, feel free to leave feedback. That actually helps with our search engine optimization as well. I'm going to read a little bit about Tony here and kind of his background. He has a longstanding history of teaching financial literacy to the medical profession. So I'm going to read his biography. Tony's been in the financial services industry for over 15 years, and he founded Corio and Associates in 2011. Tony specializes in long-term planning for medical residents, fellows, and physicians. He serves as the vice president of the Physicians Financial Resource Network, where he helps guide physicians of all levels in their personal financial planning, as well as practice planning. Tony has a passion for education and has taught personal financial lectures at over 30 different hospitals and health systems to help young physicians with their protection needs, asset building, debt management, retirement planning, and practice establishment. He's originally from South Central Pennsylvania. He attended Shipsonburg University and graduated with a Bachelor in Science and Personal Finance. We'll have his contact information listed at the bottom as well. I do want to put in just maybe a brief plug before, Tony, before we kind of maybe go forward with our questions. So obviously I'm not a financial planner, and that's why we have you, the expert in this field. I will say I've been in practice for 12 years, and I really first got interested really in finances in medical school when I saw this huge, massive debt just kind of staring at me down the barrel. And then I distinctly remember a conversation I had as a first-year medical student with an emergency room physician, and he'd only been in practice about 3 years. And at that time, I was young, married, only 2 children, just struggling financially. I say paycheck to paycheck, but it was really financial aid to financial aid. I saw this ER physician making $280,000 a year, and man, he had a beautiful house, beautiful new BMW, beautiful Suburban, grand piano. And you just think this guy has got it made. And I remember talking to him saying, I can't wait to not have the financial stress that we have as medical students. And he says, oh, you don't understand. I'm living paycheck to paycheck right now, despite having that great big income. So that was such a huge wake up. And at that point, I thought, you know what, I need to take some personal accountability and have a little bit of financial literacy. So now that we have you, hopefully you can help give us some guidance and direction. This is really geared usually to a young physician. Now, maybe that's a resident or a fellow or someone that's been in practice just a short time, although I think this really applies to physicians of all ages. Maybe what we can do, Tony, is we'll start off kind of with one of this first question, and maybe I can pose some questions and give you a chance to really elaborate on that, and we can talk a little bit more. And then in the meantime, people can leave questions in that chat function. So
Yeah, absolutely.
maybe this first question, what unique set of financial challenges do physicians have?
So Mike, your story that you just told rings true far too often. I see it in the medical community and not just the medical community, but in a lot of different professions where, you know, we look at somebody and see kind of all the outside things that they own. And as a financial planner, you know, for, like you said, over a decade and a half, I see under the hood and some of the challenges and some of the things that you don't see above the water. So that's one of the biggest challenges, is that being a physician, right, you go through a career path that very few, if any, other people will actually experience, right? You go from years and years of education through undergrad and medical school to becoming a doctor, starting a residency program, beginning to earn some money, albeit usually $60,000 or so in residency, to going from 60,000, and depending on specialty, location, what type of practice you're in, you know, going from 60,000 to 200, 300, 400, $500,000 and up, right? So easily tripling, if not more, your income overnight after signing a contract. So that is rare. That is something most people will never experience. But it comes along with other challenges as well, because the average physician, at least here in the US, is playing catch up from day one, right? And which we'll get into a little bit later with student loans. So that is unique in itself, right? And the biggest thing and biggest advice that I can give to young doctors is be aware of that at an early stage and create good habits, which we'll also talk about a little bit later, how you can do that when you're starting out, because those habits will continue with you most likely as you go out through practice, as you get close to retirement, as you're in retirement, those habits tend to stick with us. So creating those good habits early are a good thing. It's also very tough to get proper advice. Being in that situation, right? Most of the advice, 98% of financial advice that's out there in the personal finance, do it yourself, help yourself, books, blogs, websites, things like that, are for the masses, right? You are not in the masses, right? So the advice that somebody making with the average US household income, which is probably around $60,000, $70,000, may not apply to you, right? So I know there are different physician related financial blogs and things like that, but it's still advice that you find out there is very cookie cutter. So being able to pick and choose that advice and actually apply it to your situation can be very challenging as well too.
And it sure seems like everyone has an opinion too, and everyone wants to give you their financial opinion, right?
Exactly. There are a lot of Monday morning quarterbacks. There are a lot of side job financial advisors out there. So it's tough to know who to listen to.
We'll talk about student debt in just a moment. You alluded to income potential, and I think, we're blessed. Physicians have the opportunity to be great income earners. And I think there's kind of this stigma that physicians are horrible with money, horrible with running businesses. What about, in your experience, do you feel like physicians are poor at managing money, or do you feel like they're doing okay?
It's very hard for me to make a blanket statement saying physicians are not good with money. I would say in my practice, we work with people who truly want help, right? We don't necessarily work with the person who comes to us and says, here's all the things I need to do. I just need you to execute it, right? We work with the people who say, listen, I really don't know. This is out of my league. Tell me what I should do. Help educate me on these things. Those are our typical clients. So for me, it's easier to say that the physicians I work with aren't sure what they're doing, but that can't be said for every doctor right now. I will say in the medical space, especially, practice ownership, as you know, has shrunk. A lot of the big health systems or for-profit health systems or even private equity firms have been buying a lot of what used to be small private practices. So we see a lot more of our clients being employees as opposed to business owners, which I think takes some of the focus off having to learn about money and what to do with it as if you were owning a practice. But it's hard to give a blanket statement to that, but I would say in general, it's probably not your strong suit, right? Science, it's the path that most physicians have gone with. So I would say there's definitely a lot of room for us to educate.
You'd mentioned student loan debt and taking out loans. In my experience, it seems like the average medical student upon graduation is around $200,000 to $300,000 in student loan debt, in that ballpark. There's a lot of variability. What advice can you give these young physicians when it comes to managing their student debt where they're just hampered with so much right as they get out of the gates?
Yeah, another great question. I think in residency, the biggest residency and fellowship, anytime in training, the biggest thing to do is number one, just get organized with it. Make sure that you know where all your loans are. Make sure that you are enrolled in a repayment plan. I would say 95% of the time, that's going to be one of the income-driven plans, which as it stands now is the pay-as-you-earn or pay, and revised pay-as-you-earn or repay. Depending on a couple of tax factors of which you choose, but those payment plans are capped based on your income, so they make the payment manageable. So I would definitely recommend being in one of those. There are certain circumstances where maybe that's not the case. Let's say you are married, do all of your finances together, and your spouse is a very high income earner. Maybe you can do some different things with your debt at that point. But for the average resident or fellow, you don't have $2,000 or $3,000 a month to spare to pay your student loans. So the pay as you earn or revised pay as you earn, you're probably on cruise control for a few years throughout your training. There's not a lot to do there. The biggest part is when you take a job outside of your training, right? Because this is where a lot of factors fall into place. Number one, first and foremost, the public service loan forgiveness. This is something offered by the US government in which if you work for a qualified non-for-profit, which a lot of health systems are, if you make 120 payments under one of those income-driven plans or a combination of an income-driven plan and a 10-year standard repayment, after 120 payments are made, they will relieve you of your debt without any type of tax burden on that. That is a tremendous opportunity if you plan on continuing to work for a health system. If I spend 4 years in residency and maybe 2 years in fellowship, that's 6 years of payments. I need to make payments for 4 more years in order to have my debt forgiven the way that the program stands now. So it's a great opportunity to be able to do that. It also keeps your payment down even that first year outside of residency because they usually calculate your minimum payment based on the prior year's income. So you may be in repayment for 7 years before your payment even gets over $1,000 a month, which can be a tremendous asset. Now, if you go into private practice, or for some other reason the PSLF is not the path you're going to go, that's when you really need to regroup and re-strategize on what makes the most sense. A year or 2 years ago, I would say all day, every day, you're going to be refinancing those loans. We could probably find you a lender somewhere between 2 to 4%, depending on the length of term of the loan and your credit. Rates have gone up. Actually today, it's November 2nd. The Fed has announced that it's going up another 75 basis points. It's like I think the fifth or sixth hike this year. So rates are going up. They're getting closer to where you might be right now with your federal loans, which might be 6.5% to 7% usually is what we're seeing. So it does involve a little bit of strategy and what the ultimate goal is. One little tidbit of advice that I can give people, because I do have people say, I don't know if I'm going to stay in public service, or maybe I do know, but I don't trust that I'm going to actually get my debt forgiven 8 years from now, right? If I'm a secondary resident, do you still give that same advice? If I can pay a little extra, should I pay extra? My advice would be, unless you absolutely know you're not going to stay in public service working for a nonprofit, I would say if you can pay extra, let's say my minimum payment is $200 a month, and I could afford maybe $600 a month if I really stretched it. Instead of paying $600 a month to your loan provider, pay the minimum $200 and take the additional $400 that would have gone towards that and put it in an account for yourself, right? This could be a basic savings account. Likely you want to put it in some type of passive investment account to hopefully get some growth, and do that every single month, just as if you were paying your lender, right? Now, if time goes by and PSLF is not an option for you for whatever reason, now you won't feel like you wasted all of those months of not paying extra when you could have and having this big amount of debt. It's a way to insure basically against that, and you are the insurance company, right? So if you do get loan forgiveness, now you got a pot of money that you didn't think you had before, right? And if you don't get loan forgiveness, well, now you didn't waste your time or money during that time, and you have something to show for it. Maybe you could make a lump sum payment towards those loans to catch up where you were. So that's a little piece of advice if you're worried about not getting forgiveness.
Well, I think that's some great counsel there too. And just to recap, I think some of the high points you mentioned, really what it sounds like is, early on, even as a young person, learn to be intentional with your money. And like you said, have a plan with it, get organized. I remember looking at my loans as a first-year medical student, boy, and I had private loans and I had various federal loans, and, there was just a number of loans, and it was pretty easy to get confused about where I had borrowed the money from. Mm-hmm. I think that repayment plan, I think, can be a great option, and that public service loan forgiveness. I've seen that be very successful with many physicians. I've used that to their advantage too.
Yeah. Now, one thing I'll say about that, early on, I would always get questions from clients. Do you have clients that got forgiveness? Have they ever received it? And for a while, my answer was no. All right. And we serve a few hundred households of physician clients, and my answer was always no. In recent years, last year even, several $1 million of forgiveness for our clients. So it is paying off. It got some bad publicity up front. The article I always get asked about, right? I heard like 1% of people actually qualify. So that article came out very shortly after the first group of people were even able to qualify. And it was either yes or no, right? To get that 1%, it was either a yes or no. So you may have had 119 payments and you submitted your paperwork and they said, actually, this one didn't count, and it counted as a no, right? So 99% of people didn't get it. But it doesn't mean they never got it. It just means there was something else they had to do. So I as much as I'm not sticking up for the federal government, I think they got a bad rap from that one. Now, I do know there were some big errors that they made, some big mistakes that they didn't do a good job of, in which they actually spent this year trying to remedy and giving you some time to make up for that if you had payments that didn't count because the loan wasn't the right type or something like that. But we do see clients all the time getting forgiveness now, which is very, very nice to see.
That's great. Well, let's maybe turn towards insurance. There's so many different types of insurance out there that can be a little bit overwhelming for a young physician. Can you maybe comment on what types of insurance should a young physician have?
Absolutely. So as a physician, when you think of insurance, probably your mind goes to malpractice insurance, right? That's if you get sued on the job, that's what protects you. So I'm not going to get into malpractice too much because most physicians are covered under their employer plan. If you go out on your own, that's a different discussion, but you have that type of insurance protecting against liability. I think the number one piece of insurance that any young physician should be purchasing on their own is disability insurance. I can almost guarantee everybody who's listening to the call has been told that already by somebody, a salesperson or a mentor of some sort, or a co-resident. That is one piece of blanket advice that I can actually feel confident in giving, because if you don't have your income as a young doctor, a young attorney, a young financial planner, it doesn't matter what career you're in, if you don't have an income as a young person, we have issues, right? Because you don't have net worth to bail you out, to say, you know what, I can't make money do my job anymore, I'll just retire and live off of the assets that I saved, right? If I'm a 33-year-old doctor, that's not happening. So disability insurance in itself, important for all young earners. If you earn an income, you want to protect that income. For physicians, right, it becomes more under the microscope and more of a bigger recommendation, because a lot of times your work is specialized in what you do. So if you're doing procedural work or hands-on patient care or surgery or anything along those lines, what deems you disabled may allow me as a financial planner to do everything that I used to do, right? If I do procedures with my hands and I break my wrist and it doesn't heal properly, or I have nerve damage, something along those lines, if I'm a financial planner, I can still do my job, right? If I'm doing procedures on the body, right, I might not be able to do my job anymore. So now I
challenging
hundreds of thousands of dollars getting to where I want in my career, and I no longer can do that anymore, right? So there's a lot of ins and outs with disability insurance. It's going to cover specifics. It's important to know and understand your policy. You want it to cover your medical specialty. That's important, and not just label you as a physician. And a lot of the big carriers do that, but definitely some different things to look for there. I've worked, like I said, we internally probably have at least 500 to 700 disability insurance policies on the books. And I've never once had anybody come to me and say, you know what, I bought this policy 10 years ago, 15 years ago. I paid all these premiums. It sucked. It was $150 a month while I was a resident. It was not fun. And then it jumped up, and now I've been paying $400 a month. You know what? It's the biggest regret I ever had. I wish I didn't buy it. Hasn't happened yet, Mike.
No.
I have, unfortunately, had conversations with way too many physicians who said, you know what, I should have bought it. This happened. Can you help me? And unfortunately, a lot of times the answer is no, right? Disability insurance is a very, very weird product in that when you don't need it is when you can actually get it. When you need it, you can no longer get it, right? And we don't know when that's going to be for all of us. We all think it's never going to happen. But in reality, not just with physicians, but with people in general, people in their 20s have a 25%, 1 in 4 will go on a long-term disability claim. So it's probably higher for physicians, to tell you the truth.
So you said 25%. At what age
25% of
again?
people in their 20s, yep,
Wow.
will
Yeah.
at some point in their career go on a long-term disability, which is over 90 days.
And there is short-term and long-term disability. I think you were just kind of getting into that over 90 days being long-term disability.
Yeah.
I would think, most young people, we kind of grow up, we're like invincible. We think we're immortal.
Mhm.
And then we go through medical school and think we come down with every infection and malady known to man, right?
Yes.
And we start seeing it in practice. And I think most of us with time and age start to gain some wisdom, realize, oh my goodness, really, yeah, we can. We can become injured, we can become disabled, and it's not just a matter of I can't work as a physician, but I think you made a good point. Can I do my specialty as a physician? I do a lot of ultrasound guided injections and procedures. Can I use my hands? Do I have that procedure ability to do that? Do I have the cognitive ability to function there as well?
Sure. And Mike, that's where the specifics of your policy come into play as well too. Because if you get a good disability insurance policy, let's say you can do some of your job but not all of it, it's going to compensate you for the loss of income that you have, even though you're still working in that income. So it allows you to work as you can and still maintain the lifestyle that you've created for yourself and your family. Whereas some policies, if you're working at all, it's not going to pay. Right. So there's some big differences there as well, too. I always tell somebody who's buying a policy when they're young, the policy that you purchase today, right? So as a resident or fellow, price is always a huge issue, right? Well, I don't want to pay for it. I can't afford it. If you buy the budget policy with the budget benefits, that's likely the policy you're going to have when you are in your prime earning years. It's not like car insurance where you shop around every couple of years. It's a little bit of a strenuous process to get it. They go through your medical history and things like that. And the older you get when you purchase, the price goes up significantly. So you're probably not going to replace that policy in the future. So that's the one you're going to have. So if you buy the one that was the cheapest with benefits that are just okay, that's the one you're going to have when you're 50 years old making great money, because you're probably not going to replace it at that point. So I always tell people that if you don't want to pay $150 a month, I would take a deep dive into your bank statements and see what you're paying that is not as important as the millions and millions of dollars that you're going to make over your career. I'm pretty sure you could probably find something that you could cut.
Yeah, maybe you take a second look at that daily cappuccino on your way to work.
Right. Yeah.
Well, so you'd mentioned disability insurance. Is these, let's say you're in residency or you prepare to graduate from residency or fellowship, you're entering practice, and maybe you join a large healthcare system. Do many large healthcare systems offer disability insurance?
Many do, almost all of them, actually. Now, there are some big differences between them. Number one, just the benefit amount itself is usually capped. So an average disability policy is going to pay 50 or 60% of your salary. Let's just stop right there. What if you make a very large bonus, right? Or RVU bonus or whatever it might be, incentive. If it's labeled as definition 50% of your salary, that bonus is not your salary. So don't forget that. So that's not covered. So if my salary is 200 and I make another 150 in incentives, you're covering 50% of the 200.
That's a great point. Yeah.
Different lifestyle that you're now moving houses, maybe moving school districts. I'm not kidding. And it's a big difference. That's number one. And the more you earn, so a lot of them are capped. So it might say 50% up to 20,000 a month or 50% up to 10,000 a month. So if I make 30,000 a month, but it's 50% of my income up to 10,000 a month, it's really only covering a third of my income. That benefit, if it's paid for by your employer, which most group plans are, is also taxable. So maybe I'm making 7, right, when it comes after tax. So a lot of times they just don't cover enough. Aside from the amount, what it actually covers is usually not as good and thorough as what you would get on the open market buying your own policy. So some of those examples I mentioned, if you're partially disabled, right, you can't do all of the things you used to do, but you can do some of them, or maybe you just can't see the amount of patients you used to, but you can still do all your job duties. Those group plans are not designed that suite. They're either you're working or you're not. So they're not going to pay a partial benefit most of the time. So I always recommend supplementing it with your own coverage, just to make sure that you're covered for some of those better definitions. Now, if you buy it and you have group disability insurance, you buy your own personal, you may not be able to buy as much because no insurance company wants to over-insure you. Otherwise, there's no incentive for you to get back to work. So they are not in the business of over-insuring. So you may not be able to get as much, but even a supplemental plan is, I think, more beneficial.
So you talked about disability insurance. You briefly touched on malpractice. What about life insurance or other insurances? Can you comment on that for a young physician?
Yeah, sure. I think life insurance is right there as well. Something that I would recommend. A lot of, I won't say most, but there are a lot of residents who are not married. So I get that a lot of like, nobody needs to collect a check, right? If something happens to me. And that is one way to look at life insurance. Where the way I look at it is, what are you actually insuring? You're insuring the value of something, just like my car or my home, right? I'm insuring the value of that. So by saying I don't need life insurance, you're saying I don't feel my life has any financial value. You're still insuring an asset, right? Just like a physical asset. It's a little bit harder for people to comprehend. So, but at least getting a basic plan, you could get term insurance for a very low rate in order to just have that coverage in place. Make sure it's something that you can convert to a permanent product if that's something that makes sense in the future. Most of them do. But you can keep that pretty budget friendly. The other thing that I would recommend is your personal liability insurance, right? So you have professional liability insurance with malpractice. What about personally? If I drive a car, I have to own car insurance. Car insurance has limits, right? If I max out my car insurance, it might cover me for $500,000 if there's an accident and I'm at fault, if I'm sued, right? If I sue somebody and they're in the hospital for 6 months, medical bills, they haven't gone to work, maybe they have a good job, maybe they're a physician like you guys, chances are they're going to be out more than $500,000, right? Staying in a hospital for 6 months, having those bills and not, right? Or even worse case scenario, which I won't even get into if the accident is worse than that. So if I'm sued for $1 million, my auto insurance is off the hook after 500,000. Where does the rest come from? Well, it comes from me, right? Now, if I'm sitting there as a resident with $8,000 in my savings account and that's it, and a bunch of debt, guess what? You're still attractive to an attorney. An MD after your name or a DO, and they know you're going to make money, right? So they're fine taking that money over 10 years of income, right? They'll get that money. So what I always recommend is a personal umbrella liability policy. This is something you can get through your car insurance provider, homeowners insurance provider. It's sold it by the million. So if I get a base policy of $1 million, that example I used earlier, if I have 500,000 of coverage on my car, I now have 1.5 million, right? It stacks on top. One policy will cover all of your assets. So if I'm married and I have a car, my wife has a car, we own a home, I can get one umbrella policy that will cover all three of those assets. Definitely something to recommend. It's pretty cheap to get. The first million might add $10 to $15 a month to your premium. It's not a lot, but it's a lot of risk shifted off the table. For those who watch this, who have children who are getting older, maybe those teenage years, right? We don't like to talk about it, but you are responsible for them, right? Unfortunately, just happened near me, the neighborhood over. There was a bad car accident after a party, right? Some kids got injured. The kid driving is not the one who's getting sued. It's the parents of the driver. It's the parents of the place where they were before, right? Even if you're away and don't know your kids have friends over, you're responsible, right? So that umbrella policy, I would jack it up if you have teenage kids, honestly.
I think you made a couple good points too, even just the affordability of term insurance and the umbrella policy. I mean, those are both very affordable. This is not something that's going to break the bank, but can give you a lot of peace of mind.
As a financial planner, I can help you find $500 a year, $1,000 a year. I can't help you find $3 million if you get it's just fact, right?
Well, that's great. Thanks for letting us kind of grill you a little bit about the insurances for young physicians. Maybe we'll even move on here too. Maybe we can chat about cash flow. Cash flow is a nice buzz term used in the financial industry. What tips can you give young physicians on how to manage cash flow?
Yeah, this is one of my favorites to talk about because I think there are practical things that you can easily implement to help with this. Cash flow, right? It's a big one, especially in the physician world, because it goes from here to here, right? Very fast. That does not mean lifestyle is forced to go from here to here, right? But a lot of times, because we don't have system in place to prevent it, it does. So I don't know if I can switch and share instead.
How about let's see, I'm going to stop sharing.
That should bring mine up.
Yep, there we go.
So here's how most people in general manage cash flow. I'm going to just switch over to my drawing tool here. So when we get paid, right, our paycheck, generally goes into a checking account, right? 100% of it. Maybe we have a retirement account. In a lot of your worlds, this would be a 403B. If you work for a for-profit company, it could be a 401k, right? That comes out of your check before it actually hits your checking account. And then a lot of times from your checking account, this is where all of our bills are paid, right? A lot of them are auto draft. We have everything that comes out that we pay for on a monthly basis comes out of that checking account. You may do your regular shopping and things like that on a credit card, but then you pay that credit card from your checking account. If we have savings of all types over here, you may transfer money from a checking account. Maybe you have an automatic transfer on a monthly basis to that savings account, but it generally comes from your checking account. So if we stop here, right, one of the things that's important in what I do is helping people think about the psychology of money as well. This is something that's gotten much more popular in our industry over the last decade. Something that I've found is crucial to people, is teaching them how the brain kind of functions when it comes to money. It sounds silly, but it's a big factor. So think about that 403B contribution, right? For anyone who's watching the call that contributes to an employer-sponsored retirement plan like a 403B or 401k, we know that comes out through payroll deduction. Every single one. That's the only way that you can contribute to a 403B plan. Doesn't ever hit our checking account. So imagine if that payroll deduction wasn't a thing. They paid your paycheck to your checking account, and then if you wanted to contribute to the 403B, you had to transfer it from there, right? Would we be as successful as a country in saving in retirement? I'm going to say the answer is probably not, right? Especially if every time we got paid, we had to decide if we're going to contribute. Right. So if you're maxing it out, that's around $1,600 a month. So let's say you get paid twice a month, that's $800 a pay. So if every time you got paid, you had to transfer $800, you're probably going to skip a few times is my guess. Right. But instead, we don't think about it. Out of sight, out of mind. I've met with countless people, even in residency or fellowship, when they might not be contributing a lot to the retirement account. I'll ask them, hey, did you contribute to the retirement plan? I think I did. Is that the fidelity thing that comes out? Yeah, well, let's see the statement. Oh my gosh, there's $10,000 in here. I didn't even realize that, right? They didn't even know, but how much is in their savings account? Probably like $1,500, right? So because of the fact of the way that it happens, right? So two reasons that the tip I'm going to give you is impactful. Number one is that psychologically, even though we're saving, let's put some dollars here. So let's say I make, and I know for people in residency, this is not the case, but let's say I make $10,000 of take-home pay a month, right? And maybe I'm saving $2,000 a month into my savings account. That 2,000, and this is not my opinion, this is actually studied through psychology, has actually studied this, is that 2,000, even though we're putting it in a savings account, we emotionally feel like that money is leaving, just like spending it. It hurts us because it's going. The 403B contribution doesn't feel that way. Why? Because it never came to us, right? So it doesn't feel like it's leaving. So if we just flip the script a little bit, and maybe we just change the logistics of how we save. So let me go back to drawing here. Instead of the $10,000 hitting our checking, what if it hits our savings? And if we're saving $2,000 a month, that means we're spending $8,000. Right? So we know we need $8,000 to pay our expenses in this case. So why not pay ourselves this way? 2,000 will sit here in savings. Number wise, this is the exact same. We're saving 2,000, we're living off of 8. Why is it different? Well, the only thing that's happening now is we're seeing 8 come into our account. We're not seeing that 2 leave because it never came. Psychologically, it's very different. Right? If I have a bad month, something happens, maybe I take my car in, I need to spend all this money on it, I might stop that 2,000 from going into savings. How many times am I going to stop my 403B contribution happening because I had a rough month? Almost never, right? We don't even think about it because it's not on our mind. We don't see it leaving. It doesn't feel like it's leaving. Huge difference, right? The other reason that this can be very successful for people is increasing in income, right? So let's say instead of 10, I get a nice raise and I'm making $14,000 a month now. If I am making $4,000 a month more, Michael, I'm going to ask you, am I forced to spend $4,000 a month more?
I have to, it depends if you talk to my wife.
So the answer is no, right? I don't have to.
Hopefully
if it all
not.
comes into my checking and I have that $2,000 savings contribution happening, I have to force myself to say, oh, I'm making $4,000 more. I'm going to increase that 2,000 transfer to 6. Do you know how many people actually do that? Very few, right?
Yeah.
So in this case, I'm still living off 8, but now I'm saving 6. Right? Now, I can still have a better lifestyle, but I have much more control over that. So maybe I say, you know what, I do want to give myself a raise. I deserve it. And I give myself a $2,000 lifestyle raise. Well, now we're saving 4, right? Which is still better than 2. We're forcing ourselves to spend more as opposed to forcing ourselves to save more. It's a huge difference, and it will provide so much more wealth in the long run if you just compound this over years and years and years of income increases. And we didn't even talk about rate of return or where we're investing, anything like that. Just the increase in saving itself will have millions more of dollars on your plate come retirement than by allowing lifestyle to control everything.
I think you bring up a great point. I've read a lot of research about millionaires and the habits of millionaires, even years ago, The Millionaire Next Door. But it's interesting. We focus so much on rate of return, on, what about stocks, bonds, CDs, et cetera. But there's so much power. It's more important that we pay ourselves first than necessarily worrying about the minutia. Now, not to minimize the other stuff, but I just want to emphasize what you're saying. Paying ourselves first with that behavior is just so important for saving and retirement down the road.
Yeah, absolutely. So I'll let you take control of the screen again, but hopefully that was a helpful exercise.
Let's see here for a second. Let's see, did my screen come back up again?
Yep.
I remember reading some research about what three professions are the most common professions of millionaires. Where do millionaires come from? And believe it or not, one of them is teachers. Who would think teachers become millionaires? But you know what, it comes back to that principle is, well, first, they don't have like 12 years of postgraduate education, which is great. So they enter the workforce in their early 20s, and then immediately at a young age, they're investing first, and they pay themselves first. And then there's power of compound interest early on, right? Isn't that awesome? Then they look up and 65 years old, like, oh, wow, I have a pretty good nest egg here.
Yeah.
Let's see, looking back here, talking about retirement, what are some things that we can think about with young physicians with investing and saving for retirement? If you want to just maybe kind of keep commenting a little more about that.
Sure. I would say have a balance of where you're putting your money in terms of retirement accounts, liquid or taxable investment accounts, savings, other financial instruments you might be putting money into. Have a balance. We are told, right, we started this call off with talking about all the advice that's out there and some of the blanket advice. And one of those pieces of advice is max out all retirement plans first. As soon as you can, max those things out. I would challenge that. I would say to have a balance of where you're putting that. Even if you're making a high income, some of our clients are still not maxing retirement out because they have other objectives. Remember, retirement accounts are accessible at age 59 and a half or older. There may be a lot of things that you want to do before 59 and a half. There may be a lot of things you might want to invest in. Right?
And can you quickly just comment, maybe for those that don't know what retirement accounts are, can you specify what are retirement accounts?
Yeah, so by name, they're 403b, 401k, IRA. They're specific accounts that enjoy some tax benefits, meaning the earnings in the account are not taxed as they're growing. They're called tax deferred. And generally, depending on if it's a Roth or a traditional retirement account, you're either getting a tax deduction for what you put into it, or you're getting to take that money out tax-free in the future, which would be a Roth account. So there are some different aspects to them. But remember, that money is locked up. Again, we'll go back to blanket advice. For the average American, money locked up that you can't touch is a good thing, right? Because people aren't saving elsewise. If you have the ability to save more, if you are responsible with money, if you are savvy when it comes to money, you may find some investments that really pay off that you need some capital for, right? Maybe you want to invest in some real estate. Maybe you work for a practice that owns a building or a surgery center or other things like that. If you have cash on hand to be able to invest in those things, that's going to perform well better than your retirement account, in my experience, right? So I think it's important to have a balance there, not necessarily just because it's tax deferred. You should put all of your money in your retirement plan as fast as possible. Remember, tax deferred is not an escape from taxes. It's a delay in taxes.
I wish.
It's a procrastination of them. So unless you're in a Roth plan, which is a great option in which you can pull it out tax-free, unless you're in a Roth plan, tax deferred just means I'm just procrastinating paying those taxes. You will pay them one day, or your family will if you never take the money out of that. So just remember that. So I would say, and in terms of the types of investment, just for sake of time, we don't necessarily have to go through portfolio review and things like that. But if you're just starting out and you want to do it on your own, find something passive. Don't catch yourself trading individual stocks and crypto and all that things. If you have play money, sure, go ahead. But for your nest egg, I would keep it in a passively managed fund. Just continue to invest on a regular basis and let it go.
You know, I won't go into too much deep detail about this. I thought you brought up some good points too about balance, and that's just a great opportunity for maybe a young physician to connect with a financial advisor like yourself to get maybe a more detailed, personalized recommendations, what that portfolio could look like. But, you know, I think cryptocurrency and the new fads like that can be really tempting. And I think a lot of great counsel and just being consistent with many of these other investments. And I think there's just power in that consistency, not trying to time the market per se.
Absolutely.
Some young physicians are looking at buying a house. You know, Can you maybe give some guidelines about when to buy a house, how much to buy, how much is too much, et cetera?
Yeah, so I'll give you a couple of guidelines. Number one, you do have in most circumstances a doctor or physician loan available through a lot of banks offer them. Maybe not as much as used to, but they're starting to come back a little bit. So the thought of thinking I need to put 20% down or even 10% down, but then I have mortgage insurance. Look at those options. The rates a lot of times are very similar. So we've had a lot of clients use a physician loan and been successful with it. With that said, you don't want to put 0% down and be over your head on a mortgage payment that you have no equity in the home. That's a scary place to be. Good rule of thumb, if you're buying a home, try to keep your housing payment 15% or less of your gross income. So take your annual income combined if you're married, times it by 0.15 and divide it by 12, gross income, not after tax, but your gross salary, and try to keep the payment there or lower. It's hard to do if you're calculating it in residency, especially depending where you live. You know, you live in a big city, it's probably not happening. But after you get out, it's a good rule of thumb to try to make sure you're not what we call house poor. Your bank will likely offer you more, and you can likely afford it. But afford comes
Should you?
yes, there's things you're giving up, which is the ability to save and invest for your future, maybe pay off debt quicker, right? There's other things that you're foregoing by having such a large house payment. So that's probably a pretty good rule of thumb. It's not perfect, right? If I don't have student loans versus my coworker who has a $3,000 a month student loan payment, right, then that 15% maybe isn't the same for everybody, but I've found it to be a nice rule of thumb.
Yeah, you can imagine if someone's payment, their housing payment or mortgage was 50%, 50. Boy, imagine the risk there, and you just don't have a lot of wiggle room, do you? And I think some of these young physicians have, doctoritis, these big eyes, and see this huge house. And again, that ER physician analogy I used, you come out, it's like, well, I want the nice house, I want the BMW and the brand new Suburban, and then you look up, you're like, oh my goodness, that's 50%.
Yep. So just be
and your
aware
house
of
poor.
it. That's the biggest thing that we see. That's the biggest purchase is the house. And do not forget, I've owned a few houses in my life so far, and it's not just the housing payment and the down payment. Once you get in, the house is empty, right?
Yeah.
There are things to buy, there are things to change, there are things to fix, right? Especially from renting. You went from renting an apartment where you just make a call if something's wrong to you do everything. Expect to spend a lot of money being a homeowner.
Yeah, I think that's some great advice. Well, our last question here, what advice could you give regards to estate planning?
So estate planning is a very wide term. As a young physician, you can do estate planning by drafting or having a proper attorney draft wills, living wills, power of attorneys, things like that. That's kind of the basic estate planning, the start of it. Even if you don't have a lot of assets, it's not a bad thing to create those things. And usually that's all done in one setting with an attorney. They'll take care of all those things. If you have children, definitely do it because you're going to be listing guardians. You're going to be listing who's in charge of money that you leave to the children, things like that, when they can access funds that you might leave them. So those are kind of the basic estate planning things. When it comes to more advanced estate planning, as you're in the tail end of your career or even in retirement, there are different reasons for estate planning, right? And a lot of times it comes down to taxes. That's the biggest piece with estate planning. Right now, there is no estate tax unless your net worth, basically what you're leaving for a husband and wife, is over, in 2023, it'll be just over $12 million. Most Americans, they don't have $12 million. For you guys, very well may. But remember, that is an amount and a figure that can change quickly. I remember not too long ago where that amount was 1 million, right? So if you're over that 12 million, right, the average estate tax is about 40%. So Can you imagine leaving 40%, giving
40%. Oh, that's
imagine
brutal.
filling out a beneficiary form on your
Oh,
retirement plan or your life insurance policy and saying, I want my spouse to get this amount and my kids to get this amount, and I want the IRS to get 40%, right? That's what you're doing if you're not doing the proper planning to help with that. So there are different things that you can do depending on where your money is. I'm not going to get into them. I'm not an estate planning attorney, so I cannot give legal advice, but I can tell you it's a good thing to do. Life insurance comes into estate planning very frequently because there are a lot of things that you can do with life insurance to help with some of these estate planning things. If you are at a point where you are over that amount, but you're still young and healthy, gifting is a very popular thing. And I don't necessarily mean gifting charitable wise, but gifting to kids, grandkids. You can gift about $15,000 a year per person. So if you are married and you have 2 children, you can gift, myself and my spouse can give 30,000 combined to one child, 30,000 to the other, 30,000 to the other child. If I have grandkids, again, 30,000 to each. So it's a lot of money, right? I wasn't getting $30,000 as a kid in my Christmas cards, but if you have a net worth over that $12 million, it might be something that you want to look into to start to gift away your money while you're alive. There are other things and a lot with estate planning, but definitely something to start to think about even young with the basics, getting a will, getting a power of attorney, getting a living will, things like that. And as you start to gain net worth, doing some tax improvements, I guess, on your estate.
Boy, it just reminds me now as you graduate from residency, fellowship, you're a young physician in practice, you think, man, this is time to grow up, I guess. I have to be a big boy here. And I remember, I had some counsel to really surround myself with some good professionals early in my career. And that's a good financial advisor to give me guidance and kind of keep me in line, even when the stock market is all over the place. And a good attorney and a good accountant is part of your team. And I think that can really help with your estate planning. Maybe we're just going to wrap up a few things here, Tony, before we really open it up, if that's okay, to some Q&A.
Yep.
I just want to remind people about this, Leaving a Legacy, the AMSSM Foundation capital campaign. And our goal is really to raise $5 million for the AMSSM Foundation endowment. Just be aware of that. This is a second mile giving campaign above and beyond the annual gift to the AMSSM Foundation. I'll continue to, it says what kinds of funds will be accepted. It says deferred gifts with estate planning, stocks, bonds, real estate, cash gifts, etc. You can contact the AMSSM Executive Director, Jim Griffith, to discuss some more giving options, including this AMSSM campaign for estate planning. Now, for those that may have further questions, would like to tap into the financial advice and professionalism of Tony Corio, you can see here this QR code and his contact information. So Tony, my understanding is we have a lot of clients that do not live right there in the Philadelphia area. And that you will meet with, plenty of them, right? So you're happy. I'm going to put him on the spot and say that he's happy to answer any questions and to work with you as well.
Yeah, we have clients in about 35 states right now, 30 to 35.
Wow.
So they're everywhere. We were using Zoom and things like this before it was necessary for everybody to use it. So we're used to it, and we're able, as long as you're a resident of the U.S., living in the U.S. Physically, we can help you.
And I do think there's a lot of power in having a financial advisor that understands the unique needs of a physician. So I think that's really helpful, Tony. Before we answer some questions, just a heads up too, we will have our next sports economics webinar. It's actually going to be in March, and you can see the title there is Revenue Streams Outside of Clinical Medicine, which will be given by Dr. Clarence Marcus Lee and moderated by Kathy Nguyen. Now, why don't we open it up to questions? I'm going to stop sharing my slides here. Okay. All right. Let's see. I think we're back. Everyone will hear us okay?
Yep.
Perfect. Okay. So now looking at the chat function here, let's see. And I'm going to read the first thing by Andy Mayer said, AMSSM member Dr. James Robinson. I actually know Dr. James Robinson. He went to residency in town in South Bend, Indiana, just across the river from me. He just had a very relevant tweet recently about how he just paid off his student loans after 22 years. Congrats to Dr. Robinson. That's awesome. BJ Smith has a comment, says, sorry, I joined late. Did you mention disability insurance and specifically your own occupation? That's huge. We had to face that a while back. And yes, BJ, if you're still on the line, we talked quite a bit at length about disability insurance, both in the private sector and through employment, and how that is really important, especially given your specialty. Andy Mayer had made a comment, AMSSM Foundation immediate past president, Susan Joy, further discusses the foundation capital campaign here on my YouTube. And he says, thanks for joining us tonight. Let's see, now Colleen just chimed, let's see, I joined a few minutes late as well. Did he mention the best way to pay off private student loans specifically? Maybe I'll turn that over to you, Tony. Do you want to comment maybe specifically on private student loans?
Yeah, the private ones, I mean, they're going to stay private, obviously, right? So first and foremost, I would look at the interest rate that you have and see if there are any better options out there when it comes to interest rates. So that's the first thing. That's just going to depend on where your interest rate is now and what things like credit, income, things like that look like. Secondly, what can you afford to pay or what makes sense to pay, right? So when we're looking at, should I pay it off fast or should I pay it off slow? What are the trade-offs with that? Well, paying off fast will get rid of it quicker, right? You'll pay less interest over the life of the loan. Paying it off slow, you are going to pay more interest. However, you have more time to do it, right? So if we factor in inflation there, right, with how money changes over time, it may actually feel like we're paying less than we actually are with a longer term, right? So it's two ways to look at it. Now, with my counseling and what I do, I not only have to look at the numbers, the dollars and cents, but I have to be able to read my clients and their emotions towards things like debt. Debt and money in general is a very emotional thing. So if you are somebody who can't sleep at night, is completely stressed out because of how much debt that you have, maybe you want to pay it off a little quicker. If you're somebody who says, doesn't bother me, I know it's around, maybe you want to take the difference in the smaller payment with a longer term and invest that in yourself, right? Invest it in yourself, invest it in mutual funds, whatever it might be. Let's say you do that for 10 years while the other person is just paying as much as they can on their debt. 10 years, that one person is done. However, the other person still has, let's say, another 10 years to go, but they've got a large sum of money on their balance sheet that they can use for opportunity, right? They can use to invest in other things. They could buy real estate. They could invest in their practice or join a practice. There are a lot of different things that they can do. So it depends on how your brain thinks about money, because I know how mine does, but I know not all of my clients are that way. But start with looking at the loans you have. Is there a better option in terms of interest rate? And if you are creating a strategy to pay multiple private loans, usually attack the higher interest rate ones first. I say usually because let's say I have one that's $3,000 at 6%, and I have one that's $45,000 at 7%. I would probably just advise pay off the $3,000 one at 6%, even though it's a lower rate, just get it out of there. And that just simplifies things a little bit. You can then take what you're paying on that and kind of snowball that into the bigger loan and go do it that way as well too. That works.
Yeah, I found for me paying off my student loans, sometimes, boy, you just feel like you have a little bit of momentum. You mentioned the snowball effect, like, oh, I finally paid off the loan. I'm just going to take that money and push it forward. And you just feel that momentum moving forward. Got a few more questions here too, Tony. Coming up here, let's see. Chris says, with federal student loans, how are they right now? Would it be best to consolidate or wait to see what the government is going to do with loans after the hold on payment stops January 2023? Oh, the crystal ball.
Yeah, I'm not going to answer this one on record on camera what they're going to do.
You are being
I
recorded.
will say my thoughts personally, they just did the $10,000 forgiveness. I think that's what you're going to get. You had, I think, 3 different times they extended the 0%. Um, I don't think that's going to continue. But it's not a bad thing. I don't think you need to rush to consolidate if you can wait another 2 months and just to see, because I could have said that a couple of times now, and that could have got extended a whole year for clients. So I don't think it's, if you wait between now and let's say January or February, I don't think that's the worst thing in the world to see. And then it's, looking at your strategy again. Am I trying to pay it off the fastest? Am I trying to find the lowest interest rate? Or am I trying to pay the lowest amount possible on a monthly basis? What is your goal? And going from there and creating what's the best track based on that goal.
I'm always a little skeptical when the government says, I am here to help you financially.
Yeah, exactly.
So here's another from PJ Henson. When considering establishing with a financial advisor, any advice on being able to tease out who has your best interest at heart versus someone who just wants to sell financial products? That's a great question. How to find a right financial advisor. Yep,
because for a while there, the buzzword to look for, and when you're interviewing a financial advisor, is, are you a fiduciary? And most of us are now, right? Under the new laws, most of us do have to act under fiduciary responsibility. If you are an investment advisor representative, you have to act as a fiduciary, which is a lot of us. It's a lot of financial advisors are investment advisor representatives. So that question, I don't think is as effective as it used to be as a buzzword. My advice is talk to people who have worked with them. The experience that you get is, I think, the most priceless thing so we work with a lot of referrals that we get from our clients. So we were vouched for up front. Personally, and I'm a little biased in this, as I would say, work with somebody who understands physicians, because if I'm a new financial advisor, I might just see dollar signs when I see doctors. And there's a lot of doctor clients that I've worked for many years, what we would call pro bono, where I spent a lot of time and made no money on. So it's also about, who you feel comfortable with, their process. Our process is highly based on education, based on long-term relationships, not based on sales, things like that. You want to look at how they charge from a fee standpoint. Do they just charge a flat fee, but they don't implement anything? Do they charge an asset-based fee, meaning they charge a percentage of the money that they manage? Do they charge a commission-based rate? So there are a lot of different things to look for. But if I'm giving one answer, talk to somebody who's had experience with them and get their feedback. And if it's overwhelmingly good, it's probably a better fit.
Yeah, I think thinking of feedback, it's always nice. You can reach out to some of your other physician colleagues, maybe even those that are a little older, and say, who have you used? Sure. And they maybe have used more than one over time too, right? And you can get some good input.
Yep, absolutely.
Looks like Mitch wrote down, he said, particular companies, resources, or other avenues to look into that you recommend for purchasing supplemental disability or life insurance in addition to what an employee offers. Yeah, so we did talk about that earlier. Definitely supplemental disabilities, for some of the reasons I said. The definitions are stronger. If you ever leave that employer, that coverage is gone as well too. So it's supplemental travels with you. Almost always recommend life insurance supplemental to what you have through your group employer. Number one, it's usually just not enough. It's usually 1 or 2, maybe 3 times your salary. It's almost never over $1 million of coverage. Generally speaking, you're going to want more than that. The other thing that I tell people about, and I have personal experience, unfortunately, with this story, is supplemental life insurance it's a group benefit, right? So what do you have to do to get group benefits? Well, you got to be part of the group. So let's say I'm employed by a hospital. I have all my group benefits, my health insurance, my dental, all that through them. Something happens to me, I get sick.
I'm diagnosed with a rare form of cancer. I'm fighting it. If I'm not going to work, I am going to get terminated, regardless of why, regardless of if they feel sorry for me. True story, that legally they can't continue to pay me if I'm not showing up to work. If I don't go to work for a year, they can't keep paying me and putting me on the payroll, and they won't. So you get terminated. When you get terminated, your benefits stop. Now, if you're on a long-term disability claim through a group plan, that will continue to pay. That's what it's there for. But my health insurance, my dental, my life insurance, that is now gone. So if I get terminated after 3 months and I die after 6, guess how much of that life insurance pays? None. Right? Happened to my uncle. So luckily, he had supplemental insurance outside of that, but those group plans don't pay. So he didn't get hit by a bus and die on the spot. He got sick and he fought it for over a year to 2 years, and then he finally passed. But those group benefits were long gone by that point. So definitely recommend life insurance and supplement to the group plan as well too.
Elliot Hughes says, thanks for your excellent presentation. I just had to read that just to make us feel better. Do you recommend refinancing your house to pay it off in a shorter time period at a lower interest rate?
2 years ago, I did. It's likely refinancing is not going to be a thing for most people in the near future, especially right now with the mortgage rates over 7% for third year. I would just see it's probably unlikely, even if you switch from a 30 to a 15, to get better than what your 30's at right now. So probably not. In general, that strategy can be effective as long as you're saving the right amount of money. I would say, and what that is if I'm not saving more than, I would say 20%, maybe 15 stretching it, but 15 to 20% of my gross income. If I'm not saving that, by saving, I mean retirement, savings, investing, asset building. If I'm not saving that, I wouldn't put any extra towards my mortgage. I would focus on doing that first. Now, if I can save 30% of my income, maybe I take some of that off, pay down the mortgage quicker. You get some benefits for having a mortgage, some tax benefits as well too. So it's not the worst debt to have. And for the last, I don't even know, 15 years, rates have been really low. So it's a debt that didn't affect you that much in general, because you probably had a 3 or 3.5% mortgage. Now mortgage rates as of today are over 7%. So it's really hard for anybody to refinance right now for a better rate.
You know, and I will say, even if someone doesn't refinance, but they really want to pay their house down early, there's nothing stopping them from paying their 30-year mortgage like a 15-year mortgage, right?
Yeah,
if they wanted just to make extra payments.
Yeah, yeah, for sure.
Let's see down here. Can you have more than one financial advisor?
You can. Make sure they talk to each other. That's all I would say. I've had clients who said, listen, we've used this investment advisor that our family used at, XYZ company for years. We don't want to move the money from there. We like this guy, but we like that you work with physicians, you understand planning, you understand our debt, you understand other things. Can I just pay you a fee, but leave my investments there? Sure, absolutely. You can do that, right? It just depends on what you're looking for. If they are both recommending strategies, that's where it can get tricky. Strategies, they just happen to be the exact same strategies, great, but otherwise one advisor is going to try to blow up the other advisor's recommendation, right? So you want to make sure that they're talking to each other. And I would say that for all of your advisors, your attorney, your accountant, your banker, your financial advisor, your insurance guy, they should all be talking to each other, right? So if I'm making a recommendation and I go to my accountant, and they say that I've never heard of that, I wouldn't do that. And the attorney says, well, you should do this instead, right? They all think they're giving the right advice, but for you, right, this is your life. This is your financial world. You want your advisors talking to each other. For our clients, if they don't have advisors coming to us, they don't have accountants, attorneys, things like that, we can recommend some that we know and we've worked with, and we're all on the same page. If they love their accountant and they come to me as their advisor, I'll just ask, can we meet them? Can we have calls together? It is so much more helpful to you when everybody's in agreeing on what the strategy is, why we're doing it, because we're all trained different ways. An accountant is not trained for planning, for investments, right? I'm not trained to do your tax return, to look at those things, right? So I'm not trained to do legal documents, to create and draft estate plans, things like that. So we all have different skill set that are similar. A lot of people think we're all the same, but we're really not. But it's important that we all talk.
That reminds me too, Tony, maybe some insight for me. I remember when I first practiced up in Canada, I practiced in Canada for 11 years, where my wife's originally from. It was one of those things, we moved up there and say, hey, my uncle's a lawyer. Why don't we use my uncle as our lawyer? So our uncle became our lawyer. And then we found a financial advisor and found an accountant. And boy, I tell you, the financial advisor we had and the accountant had experience with physicians, and they communicated very well. Unfortunately, the lawyer uncle had zero experience working with physicians. And when it came to legal documents, he did not communicate well with the others. And it actually cost us tens of thousands of dollars. Yeah. And so I think that communication, finding those professionals that have experience and then making sure that they can communicate well, and not just using a family friend, a member of the family, right?
Most certainly, yeah.
And we've got one last question here. It says, since mortgage interest rates are so high, would you say maybe hold on purchasing a home and then just rent for a couple of years until the dust settles, or should we just go ahead and purchase?
So that's a loaded question a little bit, because I don't know the full situation. If you're looking to stay there long term, it depends on what the rental market looks like as well too. It depends on how much that mortgage payment, since it's increased so much, how much that's going to affect you. And again, going back to that guideline of somewhere around 15%, it's not the end of the world. Now, if rates do go down, let's say you did buy and rates did go down, then you could refinance in a couple of years when they do go down. So you can still take advantage of rates going down even by not waiting. But I think it just depends on some of those factors. I wouldn't overpay right now like people were a year ago, when people are putting, offers $50,000, $100,000 over asking on a regular basis, with waiving inspections and all of those things just to get a home, and pay a 7% mortgage now. No, thank you. I would not recommend that. But if you have a great deal that you find and it's still going to fit into that budget, then sure, I would still buy it. And then if rates go down, you can refinance in a couple of years. But don't force the issue, I guess.
Well, I think that concludes the questions in our chat box. Well, Tony, I wanted to thank you one more time for taking your time away from the Phillies game. We'll let you get back. I have not been checking the score.
I have not either.
Now that just because I live in Texas, I've only lived here a year and a half. I don't know if I'm a diehard Astros fan yet. I grew up in Seattle, so I'm still a Mariners fan. Anyway, hey, we sure appreciate your expertise. And again, I hope that some of these young physicians will be able to reach out to you for further questions. I think you've been a great, given some great professional guidance this evening. Appreciate you taking time. And thank you everyone else for joining us tonight. Hopefully we can see you on some of the next sports economics webinars in the future. Have a great evening.
Thanks, Mike.
All right. Bye-bye.